In today's financial landscape, volatility is no longer an occasional disruption, it has become the norm. Markets swing rapidly, headlines shift sentiment overnight, and investors are constantly trying to keep up. But here's the truth, volatility isn't just a risk, it's also an opportunity. The key is understanding the new rules of investing in a high volatility market and learning how to adapt your strategy accordingly. Let's start with the first rule. Mindset matters more than ever. In a volatile market, emotional decisions can destroy even the best portfolios. Fear pushes investors to sell at the worst possible time, while greed encourages risky bets during short-term rallies. Successful investors train themselves to stay calm and think long-term, even when the market feels chaotic. Discipline is your biggest advantage when everyone else is reacting emotionally. The second rule is diversification, but not in the traditional sense. Simply spreading your money across a few stocks is no longer enough. Today, smart investors diversify across asset classes, sectors, and even geographies. This means balancing stocks with bonds, commodities, and alternative investments. When one area struggles, another can help stabilize your overall portfolio. The third rule is to embrace volatility instead of avoiding it. Many beginners try to wait for the market to calm down, but the reality is that no one can perfectly time the market. Volatility creates price fluctuations, and those fluctuations create opportunities. Long-term investors understand that downturns are often the best entry points. Next comes the importance of liquidity. In a high volatility environment, having access to cash or easily sellable assets is crucial. Liquidity gives you flexibility. It allows you to take advantage of sudden opportunities. Another key rule is focusing on quality over hype. Strong companies with solid fundamentals tend to perform better over the long term, especially during periods of uncertainty. Risk management is no longer optional, it's essential. This includes setting clear limits on how much you're willing to lose on any single investment. Another powerful strategy in volatile markets is dollar cost averaging. Instead of investing a large sum all at once, you invest smaller amounts regularly over time. It's also important to pay attention to macroeconomic trends like interest rates and inflation. Technology and data are playing a bigger role than ever in investing. Finally, remember that every market cycle is temporary. Stay disciplined, diversify smartly, manage risk carefully, and think long-term. This is how you thrive in a volatile market.